on some aspects of it. So that's what we'll do today. I've taken the paper, I've used the original dates as they were in the paper. In fact, it was a 2013 paper. Also, I didn't change anything. I'm simply just going to apply the legislation as it stands now. I've selected some questions just to get particular topics out. And of course, I've also left some of the facts out if it doesn't apply to one of the questions that we are going to do. We're not interested in the facts. Now, unfortunately, the facts is quite a bit long. I'm going to read through it, and as soon as I've done through all of it, as I say, I've cut a lot of it out. We will look at some of the questions and answer them. Lizzie grew up as one of two children. Let me just see if I got the same slide. Yes, in a wealthy and respected family. There was never a shortage of money, as she always received what she wanted. Lizzie pursued a degree in human resources. Her parent paid for studies and living expenses while she was at university. Lizzie does not, let me just see, I just want to check my slides whether it is all there. Yes. I think the first two have changed around, so I'm going to read the first one first. Patrice and Lizzie Leon have been referred to you by a colleague of yours. The colleague did not feel comfortable to assist Patrice and Lizzie with their financial needs, as they have been close family friends for a very long time. Your practice's remuneration model is fee-based, even though you and several other practitioners in your practice carry a license to sell annuities. The practice members have the annuity licenses for those few times when a client has an insurance-related need. So far, with good disclosures, especially about commissions from the annuities, this has not presented problems. The Leons indicated that this is one of the primary reasons why they choose your practice to provide financial advice on their needs and goals. Patrice grew up as the eldest of 4 children, and his father lost his farm and everything else during a severe drought. Bad financial choices and an extravagant lifestyle. Patrice did not want to end up in a debt trap like his father, so he's very cognizant of having enough money available to cover for potential financial emergency. I'm going back to the first slide that was out of order. Lizzie grew up as one of 2 children in a wealthy and respected family. There was never a shortage of money, as she always received what she wanted. Lizzie pursued a degree in human resources. Her father paid for studies and living expenses while she was at university. Lizzie does not worry too much about money, and she believes that one day she will inherit a considerable amount from her father's estate. Lizzie pays for most of her expenses with a credit card and owes a considerable amount on this account. Patrice frequently urges Lizzie to pay this credit off with the income she earns, but she does not think her spending in this area is extravagant. General information, we've got Patrice and Lizzie Leon, the couple, age 40, Lizzie is 36, Patrice 40, married to one another. I'm not going to read that out. They married out of community of property with the accrual. Obviously, when I selected from the 3 case studies that I could find on my computer, I selected the one with the accrual, but in the end I decided not to do the estate planning part in this, but to choose other areas. Begin value of the estates for antenuptial contract purposes is given. They've got 2 dependents. There's Bene, I take it the name is, that's their son, he's age 3, and Nina, who's a daughter of theirs and who is 1 year old. Employment of Patrice. At the age of 33, Patrice took up employment with the government at the Department of Public Works as an engineer. He joined the Government Employees Pension Fund as a member at the time. In April 2013, now let me just put this into perspective. In April 2013, that was a month before this exam. This exam was actually May 2013. So in other words, a month ago. After working in this position for 6 years, Patrice was retrenched due to a departmental restructure. He received 1.235 million as a retirement benefit. Patrice received the benefit option from the GEPF and is elected to transfer the benefit to a pension preservation fund. He believes this option will allow him to preserve the benefit for retirement, but also retain the option to withdraw the benefit in cash in the event of an unforeseen contingency occurring. Patrice was able to secure new employment because of his extensive experience as a civil engineer and started working for his new employer, BNL Construction, on the 1st of May of 2013. Patrice's employment contract with BNL Construction provides for the following during the current year of assessment: a salary of 591,560 and an annual bonus of 46,700. There is currently no retirement fund in place at BNL Construction, but the company is planning to offer this benefit to its employees from January of 2014. BNL Construction has a medical aid, and Patrice is a member thereof. His total monthly premium is 5,600 for the whole family. The company currently contributes 35% towards his contribution, and he carries the balance. His non-deductible medical expenses for the year of assessment is 45,000 rand. This was for an emergency where the medical aid did not provide benefit. Assets of Patrice, the investment assets Patrice holds, have mostly been accumulated as a result of monthly savings. They are the following: the primary residence, note 1, we'll read that on the next slide. There's a market value of 3.8, and then the base cost. I'm not going to read all of the values of BMW motor car, money market 500, collective investment scheme 1.6 million, and then of course the base cost 1 million, furniture and household goods 350, and then a flat note 3. Let's look at the notes. The primary residence was bought by Patrice on 1 July of 2001 for 1.2 million. It was not valued on the 1st of October 2001. He made additions to the residence in 2003 for 300,000. Now, let me just point out at this point, I'm not doing the estate planning questions, but at this point, obviously, this information is given for you to be able to calculate, or for you to show that you can calculate the base cost of a pre-valuation date asset where it was not valued on the 1st of October 2001, and expenses, or shall we say capital expenses that forms part of base cost, were incurred after the 1st of October 2001. So I'm not going to do that. Perhaps in another session I can do that calculation if you want me to. The unit trust funds produce dividends of 27,000 and accrues interest of 30,000 of each year, both of which are reinvested in the fund. He purchased the unit trust in November 2008. 2 months ago, Patrice inherited a flat in London from his grandmother. She was a resident of the United Kingdom at the date of death. The property has been in the family for 3 generations. She stated in her will that he is not allowed to sell the property. The monthly rates and taxes are 5,500 per month, which will now be Patrice. Liabilities of Patrice, note 4, the retirement annuity is invested in the it seems as if for some reason the slides have turned around. We'll get to that now. The retirement annuity is invested in the Prudential Money Market Fund, see Annexure 2. The amount is in the current fund. That's the current value. The premium escalates annually by inflation. The projected maturity value at 60 based on the most recent fund statement is 9528.63. Now, you will see here that he's got a retirement annuity fund. I think that's on the life assurance portfolio. I'll get back to the slide. What is important here, you see the note that I've made on the slide. One of the things that we will do here is to calculate the shortfall at retirement. Now, they give you information as to what the premium is and how it increases, but in this case, it says the most recent statement received is 9528693. That's the projected maturity value at the age of 60. This person is also going to retire at the age of 60. So when we get to the retirement planning shortfall, this is the figure that I've selected to use as the maturity value of the I at that point. That note refers to what we have on this slide here. Here we have life insurance policies. There's policy 1, Policy 2, I'm not going to read all of that out. Endowment in money market, the important one that we're going to deal with here with retirement planning is the RA, Prudential Money Market Fund Note 4. The Note 4 is the one that I've just read, where the examiner has decided to give you the estimated maturity value at the age of 60. They give you the cash value now, you the fact that the beneficiary is Lizzie's spouse, and the monthly premium of 4,000. Employment of Lizzie. She's been working as a human resource manager for FNB for the past 7 years. Her employment contract with FNB provides for the following during the current year of assessment: a salary of 450,000, a bonus of 112,000 Rand non-pensionable. That was in the original paper, the wording in brackets non-pensionable. I've decided to highlight that to point out that, of course, that was done at the time to calculate the maximum RA contribution in those days. But now, of course, the salary and the bonus, both of them, if you have to calculate the maximum retirement annuity deduction, pension and provident and RA fund deductions cumulatively, they will both be taken into account as remuneration for the purposes of 27.5% calculation. Also will be part of his taxable income. Important here, Lizzie is a member of FNB's Provident Fund, not pension fund, Provident Fund. A monthly contribution to the fund is 8% of her pensionable salary. The company does not contribute to the fund. The current fund value of the fund is 252,000. The fund provides the following unapproved group life benefits. A little bit of a thing here that I'm not too sure about. It says here that there's unapproved group life benefits, and then all the bulleted points are underneath that. But obviously, not all of these benefits are unapproved. Life cover, 4 times annual spendable salary, and then income disability cover, 65% of her total cost of employment should she be unable to perform her duties until she either recovers or reaches retirement age. And then spouse's pension, a monthly pension equal to 30% of her salary, as well as 5% of her salary each child when she dies while still in the employment of FNB. According to the facts, those are unapproved. Let's assume that they are all approved benefits and not part of the Provident Fund that she is a member of. Right, let me just see if I can clear this, erase all the drawings, and I have been able to do that. And now the slide doesn't want to move because I've used the highlighter. Give control to the mouse. Sorry, my apologies. It's just that the slide movement has been now stopped by the fact that I give keyboard. Okay, and the mouse doesn't want to go away. Erase all drawings. I'm trying to move the slide, but it's not. Kirsten, if somebody can just give me a message how to get out of this. I've used a highlighter for this program, and I should have used my own. I'm going to see if I open it up. Just bear with me for a second. Is there any way that I can get out of this? No. Choose pen color, no drawing, normal non-drawing mode. I think that should do it. I'm not. Yeah, that's it. I've got it. Sorry about that. Assets of Lizzie. Lizzie inherited from her father's estate. The inheritance was invested in unit trust and offshore shares. What has she got? Townhouse, note number 5, 850,000. The base cost is 470. Honda Jazz, 95,000. The base cost is 125. Plot, note number 6, 435,000. The base cost 150. And then unit trust, note 7, 1.3 million. The base cost 300,000. And offshore shares, note 8, 600,000. The base cost 175. Now the notes regarding these assets. The townhouse was bought in April of 2007 and is currently being rented out. The rental income is 5,500 per month, which increases annually with inflation. The levy of 1,200 per month, which includes electricity, is 1,200 rand per month, which includes electricity and water. In 2010, Lizzie bought the plot in Hermanus. She's not sure whether she wants to keep it as an investment or offshore shares. Firstly, the townhouse, market value 850, the base cost 470, a Honda Jazz. I'm not going to read all of the values out. The plot note 6, we'll look at that now. A unit trusts fund note 7, and then offshore shares note 8. Then the actual notes. The townhouse was bought in April of 2007 and is currently being rented out. The rental income is 5,500 per month, which increases annually by inflation. The levy is 1,200 per month, which includes electricity and water. In 2010, Lizzie bought the plot in Hermanus. She's not sure whether she wants to keep it as an investment or be utilized as a beach house in future. She pays a monthly mortgage of 1,700 per month. The unit trusts are in property unit trust and earns dividend of 6,000 rand per month, which are invested in the fund. The unit trusts were purchased in October 2006. The shares and dividends of 6,000 rand per month, which are reinvested in the fund. The shares are purchased in July of 2000. Then liabilities, or Lizzie's liabilities. There's a plot, a bond on it of 225,000 alone, a credit card overdraft of 45,000 rand. And then, of course, there's the life assurance portfolio, so to speak. There's also a retirement annuity in it. There's life cover policy 1, policy 2. I'm not going to deal with that. I'm going to deal with the RA. It's 15,000 rand is the value currently. Lizzie owns it. Life insured, no, obviously also Lizzie. It's a RA though, member. And then the beneficiary are the children. The monthly premium is 3,800 rand. Now, just on that point, you see the monthly premium is 3,800 rand. You will see in all of these calculations, and I cleared that up with Slalani, Poseidon at the seminars, and that is that you do all of your retirement planning calculations as if the payment, the premium, is annually in advance. So in this case, you will simply take the 3,800 rand multiplied by 12 to get an annualized figure, and then take that figure as if it is contributed to the fund at the beginning of every year. Now, the retirement annuity was taken out 3 months ago. The premium escalates annually at inflation plus 2%. The maturity age is not specified, as it can be any time from the age of 55. Their testamentary provisions, Patrice and Lizzie, neither of them currently has a will. Patrice and Lizzie indicated that they want to make provision for their children in the event of their simultaneous death. They would further like provisions to be made until Nina completes her tertiary education, estimated duration of education 5 years. Once again, no question on that I've selected for this paper. I think, however, that in this case, obviously you will see from the facts the best solution will be for a testament, either a testamentary trust or any trust that can be a special trust for the children. Testamentary trust would probably be the best. I will explain that to you on Thursday. Retirement needs, Patrice and Lizzie. Patrice and Lizzie are hoping to be able to retire when Patrice turns 60. He's now 40, so it's 20 years away. They would like to receive a post-tax total income equal to 624 in retirement. They want the income to escalate at inflation annually for 25 years post-retirement. Lizzie wants to stop. Now, just at this point, I think quite often, just an exam tip, read your paper, not like I did over the weekend when I did this. I actually started calculating the amount that they need. They want an income to escalate at inflation, as it says here, but at a later point in the paper, the examiner actually provided, and he says, take the following as the capital that will be available at their retirement. I remember this particular paragraph, and the first thing I did was to rush back to it and start a calculation, just to see 5 minutes later that it is actually given. So just another indication, even when you sit and read this, it's relaxed at home, and not even under exam conditions, you may sometimes do something that you should not. Maybe you won't, but I certainly do. Lizzie wants to stop working full-time. She would like to start her own business from home, but also be there for her children when they need her, but the business must be flexible. They would like to know if they can afford it, especially with her wanting to retire when Patrice retires. Now, Lizzie's business plan. And let me tell you one of the reasons I actually selected this case study when I looked at the other two as well. The other two are actually divided into 50-mark questions. I think the one is even an old paper with two papers, each with 2 25-mark questions. This is the fact that at the seminar or training that we had last week, wherever you would have been in the country, thanks for all your hospitality while with our visit. It was nice being in all those centers. The important thing is that I looked at corporate financial planning. You'll remember there was one bulleted point that was given as a guideline. And I think I said at all the venues, it encompasses just about the whole syllabus, but there's a very real, and it gives the impression of simple solution. Now, most of the papers, when you open it up and it is a corporate paper, or it's got a corporate financial planning flavor to it, there's buy and sell agreements, there's company-owned policies. This was a little bit different, just in case. You'll see this lady, Elizabeth, I take it, wants to start her own business, and she wants a bit of assistance with that. She will probably sell the business in 6 years' time unless the business is very profitable. Did I read all of it? Let me start from the top again. She wants to start her own business. She wants to know she can afford it, and especially with her wanting to retire when Patrice retires, and then she wants to sell it in 6 years' time, and then as a human resource manager, her plan is to do executive placements within the banking sector. She wants to use the cottage at home as an office, as she's heard that you can deduct all your expenses from tax, which would save her a lot with regard to expenses. There's a question in the paper based on that. I haven't actually answered it because it's more towards the end, and I selected a block of questions that sort of follows. I would suggest that you go and look that up as well, just for in case over the next few days before you go to the exam. To what extent can you deduct your home office expenses for income tax purpose? Lizzie wants to draw a personal salary of 15,000 per month, as she wants to adopt prudent measures in order to avoid cash flow problems in the initial stage of a business. She is going to hire Anne as an assistant who will do the administration, but who could also assist with the placements where needed. She expects her turnover to be between 500 to 800,000 for the first 3 years. Initially, Lizzie will not implement the group life scheme and any pension fund within the company, and will make use of the continuation option to continue all her insured group benefits at the current rand value. There's an annex that was probably 2 pages or more. I have watered that down, and I took out that doesn't really apply to the questions out of the 100 marks that we're going to look at here today. The important ones there, the first bulleted point, inflation rate of 6%. The second one, in respect of any investment product that you recommend, use a growth rate of 11% for any pre-retirement investments and 9% post-retirement investments. All installments for a given year are payable in advance at the beginning of the year. And I said to you that it was also stated for you going into this exam coming, if an examiner should say, and I doubt if he will then, that a person needs 50,000 rand per annum, he's saying the same as if he's saying he needs 600,000 rand in the beginning of that year. Okay, I'm not going to read the rest. Before I answer the first question, just answering a question that was sent to me by about 2 or 3 persons emailing me, and one person actually sending me an email with a photograph taken. I think it could have been last year's exam. I was going to talk about that today, but then I didn't do that question. It was about the accrual claim and an asset that was taken into, that was inherited during the marriage, and that was taken at one value, or 2 answers, one value in the one, and random it was a different value. The question was basically the following: if the asset was inherited during, let's say it was inherited at the time, I'm making that the value was $1 million, and buys 3 years later and the value is 1.4, exclude the million or the 1.4. And I see it both in the previous exam. Well, again, I've looked at, and I'll make a note here, and I'm writing it down now. Include on Thursday's slides the portion of the section, and that the Matrimonial Property Act says that what must be excluded, and then any other asset that was acquired out of the income. I can't remember the exact word of that other asset. So as I see it, he must do the asset. If the person inherited a farm and the farm was worth $1 million, the payment is now worth 1.4 million. What you exclude is the entire farm, whatever it's worth, because it's still the same asset. If he had sold it and he took that asset and to a different asset, you would then, exclude that as well. But remember, say you have a unit trust portfolio, and you get $1 million and you put it into that unit trust portfolio. That unit trust portfolio becomes worth more over the years, and it's just more. But you must distinguish, I think, between what you've inherited the units at the time, and then, of course, assets that you got out of the proceeds by, for instance, dividends and et cetera, that you pay back. That, I don't know if that is to be excluded. I will give you a full answer to this, because people send me emails, and just wait for that. I'll give you in detail on Thursday. Lizzie indicates that she does not fully understand the options available under group life benefits. She mentioned that she heard that to company-owned policies. She knew the tax implications of and the position, of course, is the following. It's mostly contributions. If they say at E, they are unapproved benefits. Unapproved simply means that those policies that back up those benefits are not the fund. If it's unapproved, it's not approved as a pension or provident fund. It's not owned by a pension or provident fund. Take at the actual contributions in respect of those benefits. And if I remember correctly, there's life cover and there's also disability cover. Those benefit premiums are paid by the employer. The question is in 3.11, what are the consequences for the employer? And the consequence is simply that if the employer he deducted for income tax purposes, the answer is, I've said this in many. One must not forget that that gives us in respect of company-owned policies. Concept is the one that you see here, and I'm not going to highlight it because I've discovered that so soon I go to that highlighter, I messed. I want to do that again. So is a deduction in respect of premiums paid by the employer, where the benefit not for it itself, but the benefit for the or the director. Now, in the case of group life policies, in case of the disability of the that the employer takes out and pays for the benefit of the member. In that case, the premium paid by the employer is deductible in terms of Section 11, Roman numeral 1, as you can see. The second 11W is in respect of policies that are actually benefit of the employer, like key man policy, like a contingent liability, like a loan account, consequences for the employer. And of course, part of the question, I've just put no to discuss the answer. The second part of it would be in the next class for the employee. That's for her as an employee. Those contributions to those benefits that are paid for by the employer would form a fringe benefit, in this case in the hands of Lizzie. And that is in terms of section 2K of the 7th schedule. And as you can see in the middle of the slide here, the part in italics, they say the following is included in the person's gross income is a fringe benefit, where the employer has made any payment to any insurer under an insurance policy, directly or indirectly, for the benefit of the employee or his or her spouse, child, dependent or nominee, provided that this paragraph shall not apply in respect of insurance policy that relates to an event arising solely out of and in the course of employment of the employee. So in other words, if the policy for the benefit of the employee, it goes into his gross income, or for the benefit of his spouse. If the policy is providing benefits that arise solely in the course of his employment, then of course it's not going to be a fringe benefit. In other words, if the employer takes out two policies, the one is to provide a group life benefit to simply help the guy as the employee's family in the event of his death. If he pays that premium, it goes into the gross income of the employee and he is to be taxed it. However, if it is a policy that pays out only in the event of, say, if he falls from a ladder at the office or falls off a truck or something, in other words, in the course of his employment, in that case, this does not apply. Now, the employee will be taxed on the contribution and it is not deductible in his hand. So the premium goes into the gross income of the employee, and Section 23R of the Income Tax Act specifically prohibits deduction of the premiums in the hands of the employee, so that he is specifically taxed on the contribution that's made on his behalf. The benefits that he receives from the policy will be tax-free in his hands. Now, the following question I actually did not answer myself. I did a bit of research on the internet, and I found an article by a lady, Linda Sherlock, at Alexander Forbes. It was, you can see, published on the 17th of October 2016. Let's read the question. I'm going to go through the article, and I think you need to read all of it. Some of you are actually employed with life assurance companies, and I'm sure you know this very well. Lizzie wants to know what will happen to her group life benefits when she resigns from FNB. She does not want her benefits to be cancelled. Advise Lizzie on the options available to her, as well as the possible income tax implications. Now, currently, of course, we've discussed the tax in respect of the contributions made by the employer as it is now. Answer to question 3.2, Lizzie may have the option to convert her existing group life cover to an insurance policy when leaving her employment. Now, this article, continuing group life insurance benefits when leaving employment by Ms. Sherlock. Let's look at that. As part of group life insurance benefits, members may have the option to convert the existing group life cover to an insurance policy leaving employer. In other words, Lizzie can here go to the fund or to the employer, look, I want you to take that group life policy, which is an unapproved group life policy, and for the insurer that underwrites it to issue an individual policy to me in respect of that sum assured. Now, the article says, Lady Linda Sherlock said it was very important that members understood what life assurance benefits they give up when leaving their place of employment, and to what extent they would be able to replace these benefits in their personal capacity. Not all benefits provided to employees include the option to continue cover after leaving employment. Benefits available to convert existing life insurance benefit to an individual. Members can take out individual policy without having to go for medical assessment or testing. This allows exiting members to obtain a policy at a better premium rate than they would be able to on a like-for-like basis in the open market. We'll get through this now. Most individuals are underinsured, even taking into account the existing group life insurance benefits that they enjoy. So even if they move to a new employer that provides them with similar benefits, it's a good idea to improve their financial position by securing cover in their personal capacity. In other words, convert it to a personal policy and without the need to undergo any medical assessments. When joining an employer, one of the employer-based benefits which form part of the employment contract may be group life insurance benefits, which in the case of the current case of Lizzie, that is the case. The benefits covered will be specified in the employment contract. This may include life, disability, and or critical illness protection. The amount that you are covered for is directly related to your salary. You can remember that a number of multiples of salary in the facts earlier, more specifically, generally your risk salary, and will increase and change as your salary changes. As mentioned above, this may or not include the option to convert existing benefits to an individual policy on termination of employment. So it depends on the rules. Why is this option important? When employees retire, the benefits that they enjoyed with the company will cease. Therefore, should they have outstanding liabilities, such as debt or the inheritance consideration for their children, these may no longer be covered. By exercising the option to continue cover in their personal capacity, they can ensure they remain protected. And then I'm going to, let me just see how far it goes. It's the last page, and then we go on to the next question. Upon resignation, members have the opportunity to replace the cover that they enjoyed with their employer, reduce any financial gaps identified by their financial advisor, take out a new policy to provide protection in the event that they are setting up their own business, which is exactly what she is doing here, or partnership, and to secure any debt that they may acquire. Make sure you take the time to speak to both your human resources consultant and an accredited financial advisor when leaving employment. This will help you understand your options and how any existing benefits you're able to keep will work to ensure you can stay on track to secure your financial well-being. I think well written by the study and perfectly suits the question. Okay, this one here we're going to discuss. There's no calculation. Calculation, so I didn't want to include that. Lizzie is worried about, and I've put in the words, the possibility that she and Patrice may pass away simultaneously. This has recently happened to two of their friends who died in a motor car accident. She's especially worried about the risk in respect of their two children who are still minors. Patrice and Lizzie informed you that they are considering using a discretionary interviewer's trust as an estate planning vehicle for this purpose. Advise Lizzie on the following. Now, before we look at the actual question, and I will briefly speak about that in some detail on Thursday, if I remember. I'm just making a note. In this case, the trust that he's got here is a testament, a discretionary interviewer's trust as an estate planning vehicle. Now, in the case of a trust that is not a special trust, you know that that trust, if there's any income where no beneficiary has a vested right to, and it's not distributed, then of course it's taxed in the hands of the trust, and it's at 45%. If the trust is structured in such a way that it forms a special trust, in other words, a testamentary trust for relatives under the age of 18, if it's correctly structured, and it must be a discretionary trust, any retained income that is not distributed so that nobody gets a vested right to it yet is taxed in the trust at the rate of a natural person. So that's what it should be. But that's not the question at this point. The question is 3.3.1. I thought I'll just mention that. The risk to their children in respect of their inheritances, if they do not make use of a trust as considered. Now, the main thing is, I thought, and people could differ from me here. Firstly, let me state, I should have stated that right in the beginning, although this is an old PCE professional competency exam paper, the answers I've worked out from scratch over the weekend. I found the paper, I didn't have an answer. So nowhere does this, what I'm saying here as far as answers concerned, related to the FBI as an institution. It's nothing to do with their model answers that they've had at the time. I don't have them. This is my answer. So they're not at fault if I give you this answer and there was to be another one. Right. The natural section 43 of the Administration of Estates Act, I think, is the one that is applicable here. One can give this whole thing a short answer and a slightly longer answer, and I thought I'll put the whole section, not the whole section, two of the subsections onto the slide so that you have it and you can have a look at it. If they don't set up a trust for the children, seeing that they are still so young, but remember the one is 1 and the other one is 3, there's going to be tremendous problems. What you're going to find is that the cash cannot be paid out to them because they're minors, and it'll be held in the Master of the High Court's Guardians Fund. And also, unless security is provided by their guardians, it may even be a problem in transferring other property to them. So the answer is definitely a trust. And let me, a special trust, but that's not yet the question. Let's look at section 43, just the first two subparagraphs. The natural guardian of a minor shall, subject to subsections 2 and 3, and to the terms of the will, if any of the deceased, be entitled to receive from the executor for and on behalf of the minor any movable property to which the minor, according to any liquidation and distribution account in that deceased entitled, subject to express provision to the will, to the contrary in the will, no sum of money shall be paid to any such guardian in terms of section 1, and if the master so directs, no other movable property shall be delivered to such guardian under that subsection, unless payment of such sum of money or payment in default of delivery of the value of such movable property according to evaluation by an appraiser or any other person approved by the master, as the case may be. I'm not going to read any further, and boy, you can go and read it, but I think for 3 marks, I think it was, that obviously is, I think, what they were looking for. Anything else? How a trust can address any risk? 332, with a trust, it can be held in trust. It can be a discretionary trust. I would suggest it is a special trust. And if that is the case, the answer, now if you look at 332, I think it just counts for 1 mark. I didn't type that in. Obviously, the answer that stands out, if the monies have not been left to the children, the minors, but to a trust for their benefit, then section 43 of the Administration of Estates Act does not apply. And how the trust then can address any risk is the fact that no longer is it necessary that, of course, the monies is to be paid into the Guardians Fund of the Master of the Supreme Court or the High Court. List 1 other important provision to be included in the will to better cater for the minor children. 1 mark, the other one may have been 3, the one before. They must nominate a guardian for the children. Right? Now this becomes a little bit more complex. A friend at the bank has advised Lizzie that she should consider operating a business in a company or a close corporation as CC. instead of in her own name. She was also told that she should declare the profits to herself as a dividend, which is tax-free. Now, firstly, let me mention, at the time when this was done, dividends could have been tax-free. I've put in brackets there, that is no longer the case. You know that for the current year of assessment, dividend tax is 20%, so we will have to take that into account in our calculation. So in other words, she's going to tax the dividend, which we shall now say is not tax-free, but is taxable at 20%, instead of drawing a salary which would be subject to income tax. Of course, yes, if she draws a salary, it will be subject to income tax in her hands, but the salary that she draws in the hands of the company would not be taxed in the company, because that would be a deduction as an expense incurred in production of income by the employer. Advise Lizzie on the tax treatment of the following. Declaration of 100% of the available profits made in the company or CC to herself as a dividend. Now, just as a background, before let me go to the next slide, you'll see that a little bit later, I'm going to go back to number 31 now. They start talking about a small business corporation. Now, before we tackle this question, let us sort that out. I have often spoken to people in groups and then ask them what a small business corporation is, and it's always the case. Some people will say it is the small business, the type of small businesses that pays turnover tax, which is a micro business. Others will say, and I say, what is a close corporation or a company? If it is an SPC, a small business corporation, what is the benefit of that? And the answer would be, from a third of the class, if not more, that if it is a small business corporation, is that on sale of the interest in that small business corporation, the person is entitled, in respect of the capital gain that he or she may make on the sale of that asset, to, in fact, an exclusion of up to 1.8 million rand. Just right from the beginning, a small business corporation, yes, can be a company or it can be a close corporation, but it is still, and for tax purposes, a close corporation is also a company. So from a tax point of view, it is a company, nothing else. It is not a micro business, it is not a partnership, and it's got nothing at this point to do with capital gains tax. A small business corporation gets certain tax concessions. The one is as far as income tax is concerned, but there are certain requirements that must be met before a company qualifies to be a small business corporation. From an income tax point of view, currently, as per the special tax table for small business corporations, the small business corporation pays slightly less income tax, because on the first 550,000 rand of taxable income, the rate is less. And then, of course, the nominal rate for companies kick in after 550,000, when the rate of 28% takes over. A small business corporation is not necessarily also a small business for the purposes of CGT. There is completely a separate definition for what a small business is. A small business for CGT purposes, for the purposes of the paragraph 57, I think it is, exemption of 1.8 million or exclusion, has got an entirely different definition and can be a sole proprietor, or it can be a partnership, or it can be a company or close corporation shares that are sold. So what we're dealing with here is simply a small business corporation, and we want to know from an income tax point of view, how does that affect it? There's a lower rate, and there are also certain special writing of deductions that they qualify for. This question does not cover that. Now, advise Lizzie on the tax treatment of the following. A declaration of 100% of the available profits made in the company or CC to herself as a dividend. Now, in other words, what we're looking at this point is either what she can do is to take that, and I think they talk about that, we say about 800,000 or whatever the figure, doesn't matter, that the company makes as a profit, to draw it entirely as a salary for her to receive, as against a dividend to be distributed in her favor. Now, if a dividend is going to be distributed, the full of it, then amount of it, then there is going to be no deduction in respect of a salary earned by Lizzie. She's not going to get a salary. She's going to get a full dividend. So the company's taxable income is going to be the full amount without having that deduction. Company is taxed at a rate, as you know, of 28%. Now, if we take 100 and we say the company is going to lose 28% of that because of the tax rate of 28%, the company, we can say, I always look at what remains. The way my mind works, it's easier to determine what remains. 28% is going to be lost. The company is going to retain out of 100, 72% of the profit. That'll be their after-tax profit. What they now have, if they want to distribute a dividend, is they've got to ask the question, what is distributable? What do they want to distribute? It is the after-tax profit of 72 Rand that they want to distribute as a dividend. And in respect of that 72 Rand that remain, the company will have to pay on the shareholder's behalf. Remember, the shareholder pays the tax on dividends, but he will lose the shareholder 20% of it because that's the tax. So of the 70, in respect of the 72, and 80% will remain. And that means if we look at the whole dividend tax chain, as I would like to call it, in other words, right through the company, right to the dividend tax before it hits the pocket of the shareholder, only of 100 Rand, only 57 Rand 60 will remain. In other words, the difference between that and 100, 42.4 minus 56.7 is the effective rate, taking into account both the dividend tax as well as the company tax of 28%. That's question 4.1.1. I'm reasonably certain that I think by the wording of the section is that the examiner had wanted. Now it becomes a little bit more complicated, you'll see, as the question progresses. Secondly, drawing only a salary, receiving no dividend. Now, if she takes a salary only, the salary that she takes will qualify for a Section 11A deduction in respect of that, because it's paid to her, and consequently, the company is not liable for tax on the full pre-tax profit, because the full pre-tax profit is distributed. Company pays no tax, it's got taxable income, paid it all out as a salary. If Lizzie draws a salary of 15,000 Rand per month, that's 180,000 as indicated in the facts, the amount of tax that she will liable to pay would be 18% of her taxable income. Now, if you look at the tax tables, you will see that 180,000 falls within the 18% tax bracket, and the tax payable, as per the tax table, is 32,400, and the rebate is 13. We can deduct is 13,365. That's 19,035 that she will pay. Now that would be if she receives a salary only. Now there's the tax table. Now let me explain to you something about the tax table here. We said, I'm going 2 slides back, you'll see the only rate that is higher than 42.4 is if a person falls in the current maximum marginal rate, which starts at 1.5 million Rand. Then your marginal rate of tax is 45%. So if a person gets an income that is below 1.5 million Rand, the highest rate of tax that he can be taxed on that income would be 41%, which is less than the effective rate for dividend chain. So therefore, if they should ask you, should one not look at a combination here, and they do, then the answer would simply be select a salary based on the current tax table that does not exceed 1.5 million rand. In other words, then whatever you receive under less than 1.5 million will be taxed at a rate of 41%, which is lower than 42.4. So if you want to save tax by taking a dividend rather than to pay the income tax, it will only be you if the dividend is in respect of the figure in excess of 1.5 million rand, because that dividend will then be taxed at 42.4 effectively, as I've showed you earlier. If it was taken as a salary, it would be taxed at 45%. You see, that's where the difference comes in. And here's the question 4.1.3. Whether a combination of 4.1.1 and 4.1.1 and 4.1.2 can render a better result for their purposes. Now I've just explained it. The combination of the two will be best, but only if the taxable income then exceed 1.5 million rand. If a salary does not exceed 1.5 million rand, highest marginal rate of tax will be 41. Then you don't need a combination of the two. Anything above that, anything above 1.5 million rand is 45. And therefore a maximum salary of 1.5 and the balance as a dividend. Let me just check. I'm on slide 36. That should be 42.4. I will change that slide. Effective rate is 42.4. You'll see that on the previous slide. So once you have a combination, the higher of the one, you take it in such a way that the person is not taxed at 45% in the highest tax bracket. Now, just a bit of a discussion. We spoke about a small business corporation. Now, a small business corporation, as I said, you will find the tax table on a slide that is still to come, is taxed at a lower rate on the first 550,000 rand. The two top marginal rates for individuals, you can see shown in the two brackets at the bottom, 41% and 45%. Now, if one compares a bonus or a salary that falls in the maximum bracket of 45% to a dividend, then the position will be as follows. The bonus will be taxed at 45%. The effective rate of tax in the dividend chain is as follows. 100 times 0.72 times 0.8 means that 57.6 remains, and then it's 42.4. That's what we've just done. Now, what if it is a small business corporation? Then you must remember that the tax rate for a small business corporation is not a flat 28 as we have here. We have a sliding scale. The 28% only kicks in after the 550,000 rand. Now the thing is, and I'm going to show you that there's actually a question, and it's funny that the question was there, and it's something that I actually wrote a short article on last year, and this is before that, so you didn't see it from my article, The Examinators. I'm just saying, when I saw it, I immediately recognized the problem. And that is, if it is a small business corporation, one must not waste that concession that in respect of the first 550,000, you can pay less tax. So what I suggest in the case of a small business corporation, do not, as in the example that we've had before, compare the full salary against the full dividend income. In fact, if you look at the first 550, the percentage tax on that is just over 10%. So in other words, what I suggest is that if a person wants to take a full salary as it was in this case that we've had already, if we now change that to an SBC, one should say to the person, don't take a full salary. First, take or leave the first, how can I put it, 550, so that the company can be taxed on that. And that means that you must take out as a dividend. In other words, the rate is going to be much lower on that, and then you can take the balance differently. Let's look at this here. The 550,000 that is not paid as a bonus. In other words, if you take the 550, if you take with the SBC the first 550 by way of a dividend, then the position would be as follows. The company will be taxed on that 550. And that 550, if you look at the tax table for that, will be 59,098. And that means it represents, in respect of that 550, a tax rate of 10.745%. In other words, we take the amount of tax as per the table on the first 550,000, we express it as a percentage. Now, if it's only 10.745, it means that, in fact, the tax that will be, the amount that will remain will be, as you can see on the slide, 89.255 or 0.89255%. So instead of multiplying it by 0.28, we multiplied by 0.89 the 100 for that first figure, and then by 0.8 for the dividend as to what remains. In other words, out of that 100, then there will remain 71.4, which means that a dividend that's declared in respect of that 550,000 rand will attract tax in the chain of 28.26. Now, you've already seen if it's 28%, it's 42.4%. Now, what the examiner has done, I'll explain that to be able to answer, to discuss it with what we were busy with. That question that I've just discussed to a degree is actually asked in a later question, but what they are doing is to go to other questions. Explain the qualifying criteria of a small business 6 times half. Now, there's plenty of them. Now, please, and this is, I don't know what happened, how the people did in that year, what the students wrote, but you know, I've seen in classrooms that you talk about small business corporation. You probably would have had in this exam some explaining what a small business corporation is as per section 12 capital E, as defined in section 12 capital E, I think subparagraph 4 of the Income Tax Act. Others would have explained what a small business corporation is to qualify for the CGT exemption. Others would have spoken about a micro business and when do you qualify to pay turnover tax. This is a company defined, or a closed corporation defined in section 12 capital E of the Income Tax Act, and that's what we're dealing with here. Now, what I have here, the tax rates apply if I just took it, these little textbooks that you carry in your pocket all of the time. I know one that I always download from the internet is from the accounting firm PKF, and they give you all the requirements of what it is listed, and here they are. These tax rates, in other words, it's SE, apply if all shareholders or members throughout the year of assessment are natural persons. Now, that's the first requirement. She is a natural person. She's going to be the shareholder. Who do not hold shares in any other private company. So there's the first one, here's the second one. According to the facts, Lizzie don't own any shares in private companies. She does own shares offshore, but that's not a share in a private company, and in any event, you know, you'll see there's a definition of it that fall ways out of this definition. Or members' interest in any other closed corporation she doesn't have. Other than those which are inactive and have assets with a value less than 5,000 rand, have taken steps to liquidate, she also doesn't fall into that. And then an important one, the gross income for the year of assessment does not exceed 20 million. Now, if you want to lose a mark, do what students do, and I've marked often where a question similar to this was included. They say 20 million turnover. That's incorrect. The Act says gross income. They say 20 million taxable income. That's incorrect. It says gross income. So use the correct terminology. That's a further requirement. Then not more than 20% of the gross income of all the capital gains consists collectively of investment income and income from rendering a personal service. Now, personal service, we'll look at the definition of that, and let's look at the investment income. Investment income, let's see if she receives it, includes any annuity, interest, rental income from immovable property, royalty, or any other income of a similar nature, local dividends, foreign dividends, and any proceeds derived from investment or trading in financial instruments, including marketable securities or immovable property. That is not a question of, and this is where students can make a mistake. Don't go and look at Lizzie's facts. She owns some of that stuff and say, no, more than 20% of the gross income will be from investments. The company is going to be a separate entity from does the company qualify as a small business corporation? Not more than 20% of the gross income of the company and capital gains collectively must be for rendering a personal service, and then that investment income applies then to them. The company, closed corporation, or co-op was not a personal service provider or venture capital company. And there's a definition of personal service. She's going to be, if I'm not mistaken, she's going to place people in employment. I don't know what, I can't now remember what the technical term, if that is people that do job placements. I know sometimes they're called headhunters. Personal service includes any service, let's see if she qualifies for that, or the company does in the field of accounting, actuarial science, architecture, auctioneering, auditing, broadcasting, consulting, draftsmanship, education, engineering, financial service broking, health, information technology, journalism. I'm going to not read all of that. I did not find that anything there will prohibit that company from being a small business corporation. And there's the question, advisor whether a business will qualify as a small business corporation. I say yes, she does not render a personal service as far as I'm concerned. Discuss other requirements. The shares are not listed shares, they're private company shares. Listed shares, in any event you see, exclude overseas shares by definition. So let's leave that one. Hopefully that's not repeated. But do you see that business insurance, the way that they've put the guideline, could actually mean anything? They say a real life situation. Now, one could interpret that as a real life situation, not just the agreements and things, but small business person, she needs office space, she's going to use a home. What is going to be the tax implications of that? And remember, I've asked you to go and have a look at that. And then the tax rates for the small business, etc. So know that as well. Okay. Now we're back at that question that I discussed early. Section 4.3, a new question, and we're coming to a close very quickly because there's only 50 odd slides. It's because of the fact, of course, there's no interaction today, but that's fine. I will include more material in Thursdays. The tax rates in respect of the taxation of small business corporation have recently been changed. Now that was as at in 2013, but yes, they have also recently been changed, looking at it from 2018. Assuming that the company makes 1 million profit in the first year. Now what I think, and this is where perhaps people will get confused, the moment you see the company makes a profit of 1 million rand a year, I think a lot of people think in terms, micro business, if the income, if the trade income does not exceed 1 million, it can be a micro business, pay turnover tax. And then they concentrate on that 1 million rand rather than to see that the fact is that we are dealing with a small business corporation. That is a different meaning. It's a company or a closed corporation that is accepted as a small business corporation for tax purposes. Determine how much tax after declaring a dividend Lizzie will save by availing herself of the relief provided to small business corporations as opposed to being taxed as a company. Now, I've underlined it there. Also, don't let that put you off. That can make you think that it's not a company, it's a micro business. A small business corporation, by definition in the Income Tax Act, is nothing more, can be nothing more than a company or a closed corporation that falls within the definition of Section 12E. When it is taxed, it is a company that's being taxed at a concessional lower rate. It is a company that gets a tax concession that they afford to a small business corporation. So don't confuse it with all those other little animals out there that also compete for small business type status. Assume that the entire after-tax amount is paid over as a dividend. Now we have an SBC, the full amount is paid over as a dividend. And remember, we're dealing with an amount of R1 million. Now, what I've done, look at the tax table at the bottom of the slide. You see that it gives you the tax rates, not for individuals, but for a small business corporation. And you'll see in the very last bracket, I've highlighted that as well as the first one, that on 550,000, the tax payable is 59,098, and that anything above that is taxed at a rate of 28%. So on the first 550,000, 59,098. Now let's look at tax that the SBC will pay according to that table. You can, as an exercise, go and do that yourself and check if I'm correct. I hope I am. The tax in this case on R1 million would be 59,098 plus 28% of another 450,000, which is the remainder. And that I calculated yesterday as being 185,098. So that is the position if the company pays tax first and distribute a dividend, then the tax by the company is 185,098. The distributable profit would be the pre-tax profit of R1 million that's given, minus 185,000, which means that what remains, what they can distribute, is an amount of 814902. They can't distribute this R1 million as a dividend because some of it is lost in tax. So the dividend that they can distribute is 84902. 20% of tax on that, 80% will be retained. So it means that the after-tax dividend, if you look at that chain, is 651,922. So what one has to compare is the 814, or what one's compare on the one hand would be the 651,922 if it is a dividend, and if it is not a small business corporation, the position is the following: the distributed dividend would be 720. In other words, if it was a normal company and not an SBC, a company paying tax at 28%, they can distribute a dividend of 720, and then the net dividend income is 576,000. In other words, 18% of the 720. And now we can compare. We can say in the one case, what remains is 651,922 minus what remains in the case if it is an SBC 576. So therefore the difference is 75,922. In other words, she is in fact better off because of the fact that it is an SBC. And there's your tax table. And then we go to 5.1. And this can be a bit of a tricky calculation. You have done, no, this is the retirement one. The other one is still to some preliminary calculations, which indicate that the couple's capitalized income requirement need after retirement is 29,452,121. You will recall that when I was reading the facts on the slide at one point in time, I said to you that I started calculating their needs, and then they say, assume that this is what it is. So that's what I've done. Advise Patrice whether his and Lizzie's retirement annuity and the preserved GEPF benefit will be sufficient to provide for the couple's income need after retirement. Now, what is important here is follow the examiner's instruction. Once again, some people will go back to the facts and say, but Lizzie has also got a provident fund. It says clearly whether his and Lizzie's retirement annuity funds and the preserved GEPF. In other words, you've only got to take into account in the comparison, as I read it, the two RAs, one for each spouse, and the preserved GEPF benefit, whether that will be sufficient to provide for the couple's income need after retirement is calculated. Show all calculations. Please note that the monthly premiums are paid annually in advance. That is stated in the question. I didn't put it there. Now, in the case of Lizzie's retirement annuity fund, according to the facts, they give you a value, if I remember correctly, I read through it again this morning, I think it was 15,000 Rand. That is, let me just see if that's hers or the husband's. That's hers. She will escalate the escalation rate, in this case, by which premium is to increase to a RA, is inflation plus 2. Inflation in the annexure is given at 8. All retirement capital prior to retirement is to be invested at 11. So we've got a resultant rate of 3 divided by 1.08 is 2.777, recurring to 4 decimals. So to calculate the future value of what her retirement annuity is going to be one day, I've had to calculate, make 2 calculations. There's different ways in which you can do it. This, to me, is the simplest. The first one is her retirement annuity when she retires. If we look from today forward, the value will be determined firstly by what already is in the fund, and that will continue to grow. And the value will also reflect at the end the contributions that at this point have not yet been made, but will be made, and that will grow. So we've got to do 2 calculations. Take what's in the fund, project that forward at the growth rate up to retirement date, and then take what's in the fund and calculate the future value of that as well. I started here with the premiums, which she's going to escalate, as you've seen on the previous slide, by 8%. And to get to the future value of that, we need to first bring the current or the annual contribution payable in advance. And I've taken the monthly one and I've converted to that and turned that into present value by using the so-called resultant rate. And there you have it. 45,600 is the payment, 2.777, and another 7 interest, 20 the term, and the present value is 711,806. Now, as you know, to calculate the present value, the future value rather, of those contributions, we must now take that 711,806 and turn that to a future value using the actual interest rate that it will earn. Now, some people would do another calculation, that's to turn the 15,000 current value into future value as well. The 711,806 is a present value. The 15,000, which is the money in the fund, is also a present value. So you can see in the middle of the slide, I've added the 2 together, and I get 726,806, and that then is the total of 2 present values. All you then need to do is to take that present value, 726,806, 20-year term, 11 interest, turn that into a future value, and we can say that old Lizzie, and that normally sounds like the Queen in Buckingham Palace. It's not the future value is 5.859736. That's the maturity value of her retirement annuity fund in 20 years' time. And then Patrice's RA, like the amount needed at the end, I started scrambling around for the information to calculate it myself. And then in the part of the facts where you find the assets and descriptions to them, they actually said that he got a statement from the fund recently that estimates the RA to be worth at his retirement date 9528693. So I took that value, and I take it the examiner wanted you to do that as well. Then the pension preservation fund. Now, when you go back and you work perhaps through this on your own, take into account that this person, if you look at, although it goes back to the year 2013 when it was written, you will see that his membership, his period of employment with the government when he used to work for Public Works Department does not go back to prior the 1st of March 1998. He was only a member at the time of resignation for 6 or 7 years, and that was 2013. So no portion of that benefit that he transferred from the GAPF into a private sector pension preservation fund qualifies for a tax-free element in respect of services that rendered before 1998. So what I've done quite simply is to take the amount that was transferred, and that's the 1235. That's what was transferred, and that was done the other day. In fact, if you see there, he has just resigned. So I've simply just taken that value and I've rolled that up over 20 years at 7%, and I say the future value of that is 9,956,955. So therefore, on retirement, the lump sum, of course, will be subject to tax. Now, the next question then is, when we add together all of these lump sums that are available, if we look at the two retirement annuity funds and then, of course, the pension preservation fund, do we now say, but wait a second, you know, these lumps, the pension fund, the two RAs are all going to be subject? I don't know whether the examiner required it. I wouldn't have done it, because the question is, do you now take all of those lump sums at their retirement date, calculate the tax separately on lump sum benefits at that future date using today's rate, deduct that from the lump sum, and then say what remains is the capital? I would not do so. We don't know that they're going to take lump sums. Many people don't take other than the 500,000 rand, in which case there's no lump sum to tax. And the thing is, if you do take a lump sum, the worst that can happen is that you can be taxed at 36%, go into the highest end of the table. If you do take a lump sum. If you don't take a lump sum, you're also taxed, because the annuity that you withdraw is taxed. And depending on your income, that may even be lower than the 36 that you would be taxed on. So you make that decision, but I thought in this set of circumstances here, I would just calculate the maturity value of all of the funds, and here we have them: RA, Lizzie's RA, Patrice's RA is given, and then the pension preservation fund, I've calculated that value, and then the total is 25,345,654. And the shortfall is of course the capital needed, which is given, the 29 million minus the 25 million, and the shortfall is 4.10646.7 million rand. Then another one or two questions, and I wish I could take questions afterwards, but we're not going to be able to do that. So I see there are, in fact, only now do I wake up and I see, no, it's not a question there. Let me see if that's a question. Okay, shall I read them? Can a PSB be a SBC? That's from Biddy Skeppers. Provisional service, personal service provider? No. Dear Biddy, your question will, okay, it says it will be for you, then I'm not going to look at that. Now I'm going to get rid of it, and there it goes. Let it just stay there. Right. Question 5.2. In the light of the above, is there a specific regulatory proposal Lizzie should take note of in future that might influence her retirement situation? Discuss the harmonization of pension and provident funds. I thought the answer to that probably will be that that it is the fact that she's a member of a provident fund. That's why I highlighted it earlier. In other words, that at the time when this was written, very soon after that, they expected harmonization. It's now a year later, and it's still not there. It's been postponed to 1st of March of 2019. But yes, if she continues to be a member of the Provident Fund, if she doesn't start her own business and stay with the bank, Provident Funds will change and will also just be able to pay a lump sum benefit from 1st of March 2019, with, of course, the exceptions. She's one of the exceptions. She's not 55 years old, so she would be able to continue. Everything before that date would be fine, and she's not going to be there anyway. So I think what they wanted you to do there is to discuss the harmonization of pension and provident funds. And then 14.4.1. And you know how things work is, I just couldn't believe minutes before we started the session, I got an email from somebody. And I actually looked this up yesterday just to be able to give you the rules. And minutes before we started the session, the person also said I must phone him. A real life thing, nothing to do with an exam. He's already a CFP. I got a question regarding this. So it's practical. People ask about it all the time. Now, question 5.3, did I omit it? Yes, I see the question's not there. I'm going to read it. I've got the paper here next to me. Question, I deleted part of the answer this morning because I thought I had too much quotation from the, what do we call it, the government pension law, and I must have taken out the question. My apologies. Question 5.3 reads as follows. Critically comment on Patrice's understanding that he will be able to withdraw the Pension Preservation Fund in cash in the event of an unforeseen contingency occurring. In other words, he said he'll put the money into a Pension Preservation Fund, and for emergencies he can take a withdrawal from that. Now, according to the government pension law, the document, I have it on my computer and I opened it yesterday, paragraph 14.4.1 of that says, a member who resigns from his or her employer's service or is discharged from his or her employer's service. Now, we have 1 year a member that resigns, so it's applicable because of misconduct or ill health occasioned by his or her own doing or for a reason not specifically mentioned in the rules, and who is not entitled to receive benefits provided elsewhere in the rules, is entitled on written choice of the member to a transfer benefit to an approved retirement fund equal to the aggregate of, and then they give you the value. And this is the important part. Interest shall be added, etc. Such transfer, and this is what Patrice is facing. Such transfer shall be made subject to the rules of the approved retirement fund. In other words, the one transferring to specifying that with reference to the transfer benefit. Any subsequent lump sum benefit payable by that fund, in other words, in Patrice's case, that would then be the preservation fund, or any successor fund to the member and or his beneficiaries shall be limited to 1/3 of the said transfer benefit with interest. So should he want to take a withdrawal benefit prior to retirement date and leave the rest there, that one withdrawal, he will not be able to withdraw all of it. It's an emergency fund, shall I say, only to the tune of 1/3 of it. He's certainly not going to be able to take the whole lot out. The balance of the member's transfer benefit after deduction of any lump sum payment referred to above shall be applied for the purchase of any annuity, albeit immediately or upon the member's ultimate retirement. Now, that's the end of my presentation. It would have lasted 2 hours. I'm used to doing these things. I normally have interaction one. I've been told at the beginning that you're going to send your questions by email. The time that I've allowed for that was actually not necessary. I don't know if there are any questions that you want to post. Send them to me this afternoon still if you can, or whatever arrangement you've made with Fatima and Kristen over there. I hope to speak to you again. I hope to see some of you at the other session I have here in Cape Town. Good luck, study hard, I sent messages to somebody yesterday where I showed on my WhatsApp a lot of using those, what do you call, emoji, whatever they call it, those little pictures. And I sent a whole thing of books and then a champagne glass, and somebody said to me, Marius, we can't drink, don't encourage us to drink. I said, no, I'm not. What I'm saying to you is hit the books for days, then you'll make the exam, you'll pass. And that glass at the end means only after you've learned hard and you've passed, you can celebrate. So shows you with an exam paper, people interpret differently. And also even with that, people interpret it differently. Thank you very much. I hope you've enjoyed the recording. Sorry for the one technical glitch. It's the first time I've used this program ever. So there was bound to be one. I tried for there not to be. Thank you very much. Have a nice evening and go home. Have a nice dinner and study. Bye.